Then there's Johnson & Johnson, which was supposed to be hurt by litigation risk. Instead, the company proclaimed it was ready for any and all verdicts, which, by the way, have recently been going into their own direction. Not that anybody's talking about it. Hints of an opioid settlement gave them another boost. Now, the stock's finally broken out after languishing ever since the stories about asbestos and their baby powder broke. You've seen some headlines about plaintiffs winning huge damages lately, right? But do you know what? They rarely hold up over a lot of scrutiny when they go to appellate courts. That and some fabulous blockbuster drugs and solid device numbers explain how J&J could have a NABF. The banks, NABF all over the place. How many times do we have to hear that the inverted yield curve is death sentence for the earnings? Those macro clowns, I mean, the macro people who specialize in that, I mean, can they shut up? Bunch of sunshine. Mountebanks. Trust me. All right, how many times did the sirens of skepticism tell us to avoid being even touching JP Morgan, getting near JP Morgan, staying in the same room as JP Morgan while the Fed was cutting rates? I mean, truly, these knaves don't know jack. Didn't matter. Thanks to a robust consumer and fabulous expense control, we've seen NABF numbers from every one of these. Literally. I mean, Goldman Sachs, boy, that had been such a... Do you catch that interview with Wilf? I mean, guys throwing a couple of ties. You're backers and journalists. Okay, so you're in California, allowed to walk around naked. Anyway, I'll have more to say on Netflix later in the show. But the stock rallied today, even though the company suffered from churn, slower subscription growth in the United States, and a huge increase in spending on original content. So why wasn't the stock crushed? Because Netflix earned $1.47 per share, and analysts were only expecting for $1.03. This has never really been an earnings story, though. It's still a big, breathtaking beat. That's why the stock initially rallied as much as $22, close to only up 7. And once again, we got a not as bad as feared result. Of course, not every disappointment is a NABF disappointment. Some are genuinely bad, dark clouds with no meaningful silver lining. Look at IBM. If you can, hold it just a second. I want to look at it. Where are those? Merger. Oh, they're the merger bot. Look at IBM. I mean, it reported slightly better earnings, but weaker than expected sales. You can only look at it with these. These are special glasses that protect you from the actual numbers that IBM reported. Even though they recently bought Red Hat, a brilliant deal, it wasn't big enough to move the needle and offset the decline in IBM's enormous legacy business. It's obvious what's happening here. The doom and gloom brigade controls the narrative, but the CEOs of most companies that have reported so far saw the pain coming and took decisive action to cushion the blow. They deployed new technology, made tough decisions, and they turned lemons into lemonade in almost every case, except for IBM. The bottom line, all these not as bad as feared quarters are good news for shareholders who haven't been shaken out by all the darn naysayers. More importantly, the reminder that execution matters.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.